All right, what up there? It's Ruben from TGE, and in today's video, I want to give you a step-by-step guide on how to pick the right option contract. And I'm going to do this by one, telling you the components that make up a good option contract, how to have the right setup so you know what to pick, what expiration, what strike. And I'm going to give you a real-world example that we're doing right now with IONQ. Okay, so let's talk about what makes up a good option contract first. Uh, I wrote some stuff down here, but I kind of want to start a little bit from scratch here. So, what makes up a good option contract here? Let me put myself here. Okay, option contract. What makes a good what makes the right option contract, right? One, expiration. Two, ideal price target. Okay, these are the two components. They sound really simple, but a lot of traders tend to mess this up because what ends up happening is that they don't have realistic price targets. Sorry, not ideal price targets. Strikes. Two, strike. Okay, so you don't know what a realistic price target is by a specific expiration date, and so what that ends up doing is that messes up your expiration picking, and that ends up missing on your strike picking. Okay, and what a lot of traders end up doing is that they say, okay, I'm just going to get something that's close to at the money because that way it doesn't get affected so much for theta. But as a trader, you want to try and maximize your gains. And when you want to maximize your gains, you want to get a contract that is from somewhat out of the money into the money. Because the rampage of gamma increases and it increases delta and it increases overall the money that you want to make, right? But when you pick something that is at the money and it's going deeper into the money, gamma reduces. And when gamma is reducing, you're actually not making as much money. Delta, see, this is gamma right here. You see how it's a bell curve? This is a bell curve. Gamma is the speedometer for delta. Okay? The higher gamma rises, delta increases, which delta is what increases your option premium. Okay? And so when you're picking something, typically this is where at the money is. And gamma's high is at the money. And if you're picking a contract somewhere around here, you're on the slope down. Your delta doesn't increase as much, so you make less money. Okay? So that's picking the wrong strike already. What you want to do ideally is pick somewhere where it starts to ramp up. Get this juice right here, and then the rest is just an easy coaster down, right? You just coast down and you just enjoy the ride. That is how you pick the right strike. But there's a couple things that you have to know before you pick the expiration and the strike. And that's what I'm going to go over here. So now that you know what makes up a good option contract, the right option contract, now you need to know, how do I pick it? How do I know what expiration to pick? What strike do you need to pick? Okay, and I'm going to explain that to you. First thing is first, I'm going to give you an example here, IONQ. This method applies to day trading, it applies to scalp trading, it applies to leap options. This is how we do it for all those different types of trades, all those styles. Okay, IONQ for us right now is a leap trade. We have 2027 leap option contracts. Okay, and this is how we're doing it, and I'm going to show you how we're doing it so you could do it too. Okay, so first thing is first, you need to figure out key levels, like where are support and resistance levels, so you know what's in the way, right? For us, it's really simple. We just use Gextron to kind of help us. Like, we just look for the tall bars, whether they're positive or negative, and we mark them. Hey, this is a key level, this is a key level, and this is a key level. Negative bars are actually levels of support if price is going down to them. The green bars are actually levels of resistance if it's going towards it. Okay, so FYI. And then that's step number one, right? I'm just gonna go to Excalidraw here. Let me say key levels. So must know before you pick an option contract, you must know the key levels. So that's how we do it. That's how you could do it as well too. And then the next thing you want to do is know the expected move. This is really, really important. Okay, very, very important. I'm gonna even draw a star next to it. This is very important. Okay, because this is what's going to help you pick the right expiration and the right strike. Okay, so here's how you could do it with I'm going to show you a DIY method, and then I'm going to show you the Gextron method. And just know that Gextron I've been tweaking this for a year now, so like it's pretty on point. Okay, but I'm going to give you the DIY method, which is better than any other indicator that you may use, like ATR or ADR or whatever that's called. Okay, first thing is first, in the case of IO and Q, we got a 2027 leap because we want to capture an entire quarterly move. And we're not delusional either. We know that there's ups and downs in the market. Not everything goes in one direction. If it does, that would be awesome. But that's not the case. So, especially when we're thinking about quarterly moves, we have to think a little bit more long term, okay? Just be more realistic. Like, it's going to have lots of ups and lots of downs. So, it's about picking the right expiration at this point, right? So, we know that the next earnings date for IO and Q is not until August 7th. Okay? After earnings, you want to calculate the expected move. Maybe wait a week or so until like IV cools down a little bit, right? It cools off, and then you can have some non-skew numbers, and then you could do this method, right? So the first thing is first, we want to figure out the quarterly expected move. And because we're aiming for the next cycle, which is 3 months away, we're going to get a year out. Anything that's greater than the earnings date is ideal for expiration in this case. But we're going to get a year out because we actually want to swing this for a little bit longer. We're going to see if we can capture 2 quarter movements. But for now, we're just going to focus on the current quarter, which is until August 7th. It ends. And once you do that, once you know the next earnings day, you go to their option chain or to any option chain, and you say, okay, where is the closest expiration to earnings? I believe it's August 25th. We'll just go with August 25th. And this method that I'm going to show you to get the expected move, right? You go to the expiration date, and this is going to be called the at the money straddle expected move. All you do here is that you grab the call ask price and you add it with the put ask price. And I circled it here for you. Puts, calls, you get this at the money call ask price and the at the money put ask price, 710, 540. You add it together and you get this number, $12.50. And you put a plus and minus there just to know this is the range. This is future range for IO and Q as of right now. Okay, I'm doing this right now. Okay, that's not all. The next step to figure out the expected move is that you gotta add these numbers. You gotta do something with this number. So to get the expected move to the top for the quarter, I'm gonna say QEM. I'm gonna say QEM is that you're going to add the current price plus the number that you got. And then the QEM bottom is current price minus the number that you got. And that gives you your quarterly expected range for the top and for the bottom. Now you have all the components to pick the right option contract. Okay, because now you know what you're aiming for, what expiration, which is August. So any expiration after August would be ideal, right? And for the strike, now you know what range to pick. Okay, if you can get anywhere within that range, that is ideal. That is the ideal thing. Okay, And so all you got to do is you grab this number and you mark it on your chart. And so this way it's visually on your chart. And the next thing that you do is that you just go to the option chain. When you go there, let's go to the option chain here for IONQ. Now I'm going to show you. We'll do September. Let's say it's August, we'll get September. When you're looking at the option chain, let's say I want to go calls. And we know that the range here, I'm going to give you the range that I got originally, which is $53.20. I just want to pick a contract that is somewhere within that range, $53. So anywhere between now and $53 is an ideal target. But I'm going to give you one more thing to know. When you're picking the right option contract and you want the highest probability, whether it's for puts or calls, you want to pick a strike between these deltas, 50 and 25. These are the highest probability strike deltas to get you out of the money and into the money. So you can take advantage of this ramp up. Okay? If you're too low, it's too little gamma to make any significant type of money. Okay? So now you know. Okay, so 50 to 25 delta. So yes, my target can be $53, the quarterly expected move, but the delta is only 16. You can see it right here. Let me just filter this out. I don't want rho, I don't want vega, no theta, no gamma. Only delta. Here's the delta. 53 is only 16 delta here on the call. So if I want to pick a September 19th, okay, let's go to September 19th. September 19th, there is, oh, actually perfect. I was looking at something else. Okay, September 19th. It's after August, right? After the earnings. You can get as far away as possible as $65 if you need something that's cheaper, right? But if you know that the target is $53, perfect. Just get something that's the $50 range, which is a 42 delta, or a 55 strike, which is a 36 delta, right? And that can potentially get you all the way up to these levels right here. Now, in the case of my leap, I have the 70 strike. It's a 56 delta. It has a very high strike. So already, as IONQ goes up and up, I'm already making a lot more dollars. Now, it's not going to be the same type of gains as it would be a 25 delta or a 38 delta, because I'm already close to, like, 50 delta is pretty high in the gamma chart. Okay, 50 delta is pretty high. So I won't be making the same returns, but if I do pick something that's like September 19th or 17th, you can always try and aim for a 38 delta or a 45 delta, just kind of like how I said right here. Pick a strike that is within this range. Now, let's say that you want to pick August 15th, which is that week, that month of the earnings. It's pretty close, right? And we know that it's $53 is the expected. Perfect. You can see here it's still a high delta, 37.29. Okay, let's see July 25th. Still a high delta. There's a lot of good expectation, except for this. I don't know why they have a blank there. Okay, so there's a lot of good expectation for IONQ right now. It's very, very bullish. Okay, if by any chance you go to a ticker and let's say the expected range is $53 like I marked, and the $53 strike is not 25 delta, don't pick that strike. Always pick the strike that is within the range and that has at least somewhere between 25 to 50 delta. That's what makes the perfect option contract, or the option contract that's going to give you the highest probability of being profitable. So pick a little bit further out of expiration date, pick a strike that's within the range, and that is preferably somewhere between these deltas. And then you got a really good option contract with a high probability of winning. All right. If you want to trade with me or if you want to try out Gastron, I'll put a couple links in the description box. If you have any questions about this, leave the questions in the comment section and I will get back to you. All right, peace out.